Good day. I am Marc Auboin, and I am a counselor in the Economic and Research Division of the WTO. Today, I am here to make an addition to the existing presentation of the WTO on its role in trade finance. And since we are in April 2011, and that the initial presentation was done about a year ago. Let me just update new developments since we have been making this initial presentation. We basically ended up the presentation of our activities in trade finance, our initial presentation at the time when the G20 support package for short-term trade finance had been adopted by the heads of state and governments in London. That was in the spring of 2009, and we have, as I have explained in the earlier presentation, we have, as a WTO, given some leadership, along with the President of the World Bank, some leadership to the initiative of the G20 that has committed to pool the resources of various international organizations, public-backed institutions, to support nailing a trade finance market that has been hit by the contagion of the financial crisis. So basically the mandate of the G20 meeting in London was to ensure the availability of an additional capacity of about $250 billion in short-term trade finance. This was a sort of blanket increased capacity that would provide for the necessary liquidity and risk mitigation that was needed at the time in the view of the shortages of trade finance that occurred. So this is time to look at what has been the outcome of this package and whether it has been successful indeed. Now, at the time, the estimates by international organization of the market gap, that is the lack of trade finance in the market to serve the traders and the bankers that were financing trade, the estimate was to be around $250 to $300 billion. That is roughly 5 to 10% of the total market. And when we look at the outcome, because there have been some monitoring of the G20 package, we see that the support provided by the various public-backed institutions has been fairly front-loaded, which means that within a year of the start of the initiative, around $170 billion have been mobilized by three types of agencies. One was the national export credit agencies, the multilateral development banks, and also other national public-backed institutions, all of them providing for short-term finance guarantees or working capital. Now, $170 billion have been provided in extra capacity, mainly from export credit agencies in the form of either guarantees of existing letters of credit or of extra working capital provided for small and medium-sized enterprises. Now, one can say that this is a relatively remarkable mobilization of these actors, and it strongly helped restore confidence in the market. That is at least one of the messages that are being sent to us by the private sector, in the sense that this extra capacity was provided in support of the private sector and sometimes in co-financing with them in order to help them shoulder the risk in a period where there has been a negative reevaluation of risk and shortages of liquidity. Now, we can say that the G20 leaders have, in a sense, been open to looking at the fine-tuning of this package, and whenever was needed, the package could be relatively flexibly oriented towards the regions of the world that needed the most the finance at the time. Now, what we see relatively rapidly in the course of 2010 is a restoration of good liquidity, a return of appetite for taking risk in the area of trade finance, both as a result of the recovery of trade and the recovery of finance as well. So we can talk about some normalcy, back to normalcy, in the bigger avenues of trade, and that has basically been the message of 2010, rebound of trade. If you look at the statistics of the WTO, an increase of trade volumes of around 14.5% in volume terms, even more in value terms, and that has been accompanied by a satisfactory funding provided by the financial sector. Now, while most of the big avenues of trade have returned to normal in terms of financing trade, and I'm here speaking, of course, of Asia, intra-Asia trade from developed countries, one cannot say the same about some regions that have been affected by various incidents during the crisis, in particular those regions that have been prone to sovereign default, those regions that where banks are being in difficult situation with respect to capital adequacy, with respect to losses, and other regions where the capacity actually to attract investors in the market, for example, the low-income countries, is also in doubt. So when you look at the full picture of things, what you find in trade finance is no different than what you find in the rest of the world economy, which is essentially that there has been a multi-speed recovery of trade finance, whereby most trade flows are being financed on a satisfactory basis at affordable prices. But if you go at the margins of the market in the smaller avenues of trade, but still are important avenues of trade because they concern South-South trade, a large number of small and developing countries, then you find a situation that is slightly different with the reassessment of risk by the private sector, with also greater regulatory requirements with respect to capital and liquidity. There is indeed less appetite for taking risk, or at least engaging capital to back trade finance operations in low-income countries, and therefore that has started to come to the ears of the heads of states and governments who were looking at the follow-up on the London G20 trade finance package. What came to their ears is that while the situation was being re-established or was being consolidated in, as I said, these main avenues of trade, in fact, many small and vulnerable countries in the world were still seeking affordable conditions for trade finance. The situation was not getting back to normal. And therefore, as a result, in Seoul, in the fall of 2010, they've decided to look into the matter and to assess actually the situation, whether there was a gap with respect to the countries that have been mentioned a gap in terms of availability of affordable finance, and whether this gap could be addressed by additional capacity to be provided by the institutions that are specialized in mitigating risk in these countries, which is essentially the multilateral development banks to start with, the IFC, but also all the regional development banks that are operating the so-called Trade Finance Facilitation Program, which I have been describing in the initial stage of the presentation, of the earlier presentation. Now, what the G20 in Seoul has been actually asking for, to be a bit more precise, is to do an assessment and a monitoring of these trade finance facilitation programs. And they asked the WTO expert group on trade finance to do that, since the WTO expert group is made of both multilateral development banks and the private sector, so they could target best the areas where the private sector was eventually retreating and where the public sector could eventually step in. And therefore, this evaluation was done in the early 2011, was already submitted to the Sherpas of the G20 in February 2011, and that report is following its course, certainly to give a hint of it, confirming the diagnosis that the low-income countries are left behind in this recovery, and that there is certainly a need for increased capacity to be provided by the multilateral development banks with respect to trade finance, something that is certainly being examined at the level of the ministers and eventually at a higher level when we approach the G20 summit in Cannes. Now, the other thing that the G20 summit in Seoul has been asking us to do, collectively as public administration, was to review also the regulation pertaining to trade finance. What is happening as a result of the financial crisis, and certainly something that is very justified, is a re-regulation of the financial sector. Now, as I have mentioned in the initial presentation, trade finance has always benefited from a fairly favorable capital and other treatments with respect to the regulation, because it is essentially a safe business. And actually, we have worked at giving a proof of it under the auspices of the Director General of the WTO in the expert group on trade finance. The private sector has committed, under the broad umbrella of the International Chamber of Commerce, to establish a loss default registry, which is a registry whereby most of the bigger banks in the world would actually look at their trade finance instruments, what is in their books, and actually calculate the default of payments on these trade finance transactions over time. And what actually the International Chamber of Commerce has seen through this registry, which took about a year to put together, on the basis of 9 pilot banks, which are the 9 largest in the world, is that trade finance is indeed one of the safest, if not the safest, financial instrument in the world. Why is that? Because when you look at the registry, which embodies 5.3 million individual trade transactions that have been financed either through a letter of credit or through an import or an export loan, you actually find that there has been only 1,140 default of payments, which means that only 0.02% of the total number of operations have given have led to a default of payments, of which 60% of that money has been recovered, because, as you know, when you finance trade, the financier, which is the banker, has a possibility, if not paid, to have ownership of the merchandise and eventually resell it. When you look at the overall statistics, trade finance is indeed a safe proposition for trade finance. It is important that the regulatory incentive remains, that is, the incentive given by the regulator remains for trade and for the trade financier to remain in the business and not go into other more risky and perhaps more toxic businesses. So we are looking into that. The G20 summit in Seoul asked for a review of the possible unintended consequences of the so-called Basel III package, which is the package of re-regulation of the financial sector. And within that, we are looking at the matter of trade finance in the sense of keeping its relatively privileged regulatory status, and we have entered into a dialogue with the Basel Committee on Banking Supervision and the Financial Stability Board. Again, a report will be provided by the regulators, the international regulators, to the G20 in Cannes for the next summit. Now, with this and with this ongoing work, let me just thank you for your attention, and let me give you a couple of references. I have been mentioning the ICC survey, which is interesting in itself because it gives you a good feel of how trade finance operates, how risky this is, and this survey that I've been mentioning about loss defaults, but also they also provide regularly sort of stock taking of the market on trade finance. They have so-called market intelligence survey, which means that they survey the several hundreds of bankers on how the market is doing. Since we do not have comprehensive statistics on trade finance, the ICC surveys are certainly one of the things that has to be looked into. So let me give you the website in which you can find all this material. That's www.iccbwo.org, and you will have on the front page a link to the Banking Commission activities of the ICC, and I highly recommend it. I also recommend the reading of trade finance material by the World Bank. The World Bank, through its private sector subsidiary, the International Financial Corporation, is having very large activities in trade finance for development. And there we highly recommend you to go into the ifc.org website, which has a lot of very good material, synthetic material on its activities on trade finance, particularly in the low-income countries, as this is the focus of the IFC. So with this, again, I thank you very much for your attention, and I hope you have enjoyed the course. Thank you very much. Bye-bye.